Vanguard just made its biggest cut ever, a cut worth more than $350 million to investors. I'll count down my 7 favorite Vanguard ETFs to buy, when you should own each, and show you exactly how much you're going to save compared to other popular ETFs from Fidelity and iShares. In fact, comparing these ETFs, I found one popular fund costing investors over $188,000 more to hold instead of the Vanguard alternative. First up here is Vanguard's most popular fund, the Vanguard S&P 500, ticker VOO. This one isn't even one that saw its fee cut because it's already a rock bottom 0.03% expense ratio. That means you pay just $3 a year for every $10,000 invested in this ETF to own every stock in the S&P 500 index. And as that index fund, this is the stock market, or at least the way most investors think of it. The fund holds the stocks in the S&P 500 market index, the 500 largest companies in the United States. That's all the bellwether stocks like Apple, Nvidia, Microsoft, and Berkshire Hathaway. Because the market index is set up to hold more of the biggest companies, the fund is very heavily weighted towards the tech sector, with nearly a third of its assets in the sector. And that could be a positive or a negative depending on how you look at it. That huge tech weighting with the magnificent 7 stocks has driven a strong 85% return over the past 5 years, but it does put a lot of your money in just one group. It's still the market fund to hold though, and is going to give you that market return, but I'd also pair this one with another fund that maybe gives you more of these other sectors to spread the risk out a little. And maybe you can see why Vanguard didn't feel the need to lower the fees here in its $1.3 trillion VOO fund when you compare it against fees for other similar ETFs. For example, the SPDR S&P 500 Trust, the SPY, holds exactly the same stocks, but charges a fee 3 times higher. But then both of them are cheap compared to the Invesco S&P 500 Equal Weight, the RSP, with its 0.2% fee. Now to be fair, while the RSP does hold the same stocks, it holds all 500 names in equal weights rather than that typical S&P 500 market cap weighting, so there is a reason to hold the fund to get that equal weighting, but I'm not sure it's enough to get over that massive fee difference. For example, investing $500 a month in each of these 3 ETFs over 30 years, and you see what a difference those fees make. Investing for the rock bottom fees in the Vanguard fund would mean almost $17,000 more compared to that SPY, and over $46,000 more than investing in the RSP. Now here those other funds want you to believe that 0.1% difference in a fee doesn't matter, but you see what a difference it can make over decades. If you're comparing the same fund strategy with the same stocks, wouldn't you rather have that extra $46,000? We're just getting started into those fee cuts that are going to save Vanguard investors $350 million a year. But why this is happening is, well, after screwing investors with a $106 million tax bill, a change I highlighted on the channel, new CEO Salim Ramji figured it was time to win investors back. Just 6 months into his role as chief, the manager of $10 trillion in global assets is slashing ETF fees by 20% across 87 Vanguard funds. A list of funds with those lowered fees beyond the 7 I'll highlight in this video are available on its website. But to give you an idea of how big of a change this is, shares of other ETF providers like BlackRock, Invesco, and State Street all plunged by more than 5% on the news. I want to get back into our list, but stick around and I'll show you how to use each of these funds in a portfolio and how much to invest. One ETF you might consider pairing with that VOO, the Vanguard Dividend Appreciation Fund, the VIG, one of the ETFs that saw its fees cut to just 0.05% a year. This one holds shares of 337 companies with a history of increasing their dividend payments every year. And while you see some of those big tech names here, you've also got a lot of others like Exxon, Visa, and Costco. It's still 25% of the fund in tech stocks, but enough spread into those other sectors like financials and healthcare that this one should hold up better in a recession. So here maybe you're looking at a little slower growth, though the 60% 5-year return is still very solid, but you also get a higher dividend yield and more safety for your money. And in the biggest fee difference in the list, you really get an idea of how insane it is to pay those higher ETF fees. The iShares Core Dividend ETF, the DGRO, charges a 0.08% fee, while the Fidelity Dividend Growth Fund charges more than 15 times on its 0.78% fee. And while the stock holdings don't match up exactly here, the strategy is the same in all 3 funds, holding the shares of those dividend growth stocks. And just so you don't think I'm cherry-picking ETFs to compare against those Vanguard funds, take a look at the 5-year chart of the VIG versus the iShares Core Dividend and the Fidelity Dividend Growth funds. While the Fidelity fund has underperformed the other 2 funds by a wide margin, The correlation between all three shows they're basically identical funds. In fact, the Vanguard and iShares funds almost track each other exactly, and the Fidelity fund would as well if you moved that chart up a little. These funds hold just about the exact same stocks. The only difference is the price you pay to hold them. So with that in mind, does it make sense to you to pay $188,000 more to hold that Fidelity fund? Hell no, it doesn't, but that's how much investors would be paying over 30 years. Here's that same idea, investing $500 a month over 30 years in each ETF. The difference between the Vanguard and the iShares fund is just over $8,000, so not that big of a deal. But that 0.75% difference in fees is massive between the VIG and the Fidelity fund. This next ETF has one of the biggest fee differences to save you money. But if you've ever wondered what's in my portfolio or want to see the stocks I'm buying, you can now by joining me on the Blossom Social Investing app. The app was created by investors for investors. I just started using it last year and love it for getting ideas and sharing my portfolio. This isn't just another investing app though. You can connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see portfolio insights like percentages and average dividend yield across the entire group. You'll also be able to join more than 200,000 investors in the social feed to see what everyone is talking about. I've shared my portfolio on the app. It's totally free to download, so look for that link I'll leave in the description below. For our next stock on the list, you say you want that growth. Here you got it with a 140% 5-year return on the Vanguard Technology Index Fund, the VGT, and now with a lower expense fee of just 0.09% a year. Where those two prior ETFs tried to spread your money out across different sectors, this one is all tech all the time with almost 45% in Apple, Nvidia, and Microsoft alone. The fund holds shares of 316 companies in every industry of tech, with an overweight in semiconductors, software, and hardware. So this one is for those of you that want that faster growth for your portfolio and are willing to take a little more risk by being so exposed to just one sector. Then again, tech pretty much is the economy right now, so if it goes, so goes the entire stock market. Now holding this one, I would also make sure to have some money in those bond funds and the real estate funds like the ones we'll talk about later. That's going to give you the safety of bonds and cash flow in real estate stocks, so if tech does tumble, you'll have that money to buy in at those lower prices. Against that new lower fee in the Vanguard Tech Fund, we have the iShares US Technology ETF, the IYW, and its 0.39% expense fee on stocks that look oddly familiar to the Vanguard holdings. This is another example of paying more for the exact same stocks and returns. Over the last year, you couldn't tell the return apart from these two ETFs, and more importantly, they track each other exactly, an almost perfect correlation. So then does it make sense to pay that extra $80,000 to hold shares of the IYW ETF instead of this Vanguard Technology Fund? That $1.4 million portfolio might mean you can splurge on the $200 caviar, but you better save all you can if you're going to be paying that $5 a pop for mustard to put on it. Emerging market stocks and the Vanguard EM ETF, ticker VWO, have lagged with just a 5% return over the last 5 years, but there are reasons to hold this one. Besides the just announced fee cut to 0.07% and the 3.2% dividend yield, you'll have your money in over 5,800 stocks of companies across the developing world. What I like about getting your EM stocks in a fund here is you're going to get stocks in there that aren't traded on the U.S. exchanges, so you wouldn't otherwise be able to buy them. Now, the fund does hold about a third of its assets in Chinese companies. That's just a factor of being the world's second largest economy, so there's going to be assets there. That exposure may hold the fund back while we get into our little pissing match among governments, but you're also spread across the developing world here with India, Taiwan, and everywhere else. The upside to this fund, besides that diversification across thousands of companies across the world, is the valuation. Stocks in the VWO trade for an average price of just 15 times their earnings. That is a 50% discount to the 27 times price to earnings valuation that you're going to be paying on stocks in the S&P 500 market index, and even cheaper compared to the 40 times PE ratio on tech stocks. Against this, we have the iShares MSCI Emerging Markets ETF, ticker EEM, with its 0.72% expense fee, more than 10 times the fee you're going to pay on that Vanguard fund. Not only have the two funds tracked each other almost perfectly, with a slight 4% outperformance in the VWO, again here, the fees mean the difference between eating ramen and top ramen in retirement, investing that $500 a month in each of these over 30 years, and on the fees alone, you'll have $168,000 more in the Vanguard fund than in the EEM. Next, I'll highlight a fund that almost nobody owns, but every investor needs. But folks, I understand this isn't as sexy as talking about the next hot stock to buy, but might surprise you that I have over half of my money in ETFs just like these. And I know all you out there in the nation are probably tired of hearing me talk about the core satellite strategy, but I do it because so many of you are missing out on the best strategy to build that sleep at night portfolio that are going to reach your goals while still giving you the upside return you want. The strategy is called the core satellite because you have that core of investments that make up between 50 and 75% of your portfolio. These are in those exchange-traded funds. For example, you might have that 15% of your money in the Vanguard Real Estate Fund, ticker VNQ, which holds shares of companies in the real estate sector. Maybe you hold another 10% of your money in this Vanguard Long-Term Bond ETF, the ticker BLV, which invests in thousands of bonds and pays a 3.9% dividend. So here, by investing most of your money, that core 50 to 75% in those 3 to 5 funds, you get that instant diversification across stocks, bonds, and real estate. Your money is spread out across hundreds, thousands of stocks. You got bonds in the bond fund and cash flow from that real estate fund. Then, with that satellite portion of your portfolio, the remaining 25% or so of your money, you invest in individual companies that you really think could produce those higher returns. The beauty of this core satellite strategy, though, is because you only have maybe 25% of your money to invest in these individual stocks, and say you invest in 3 to 5% in each stock, that means you're only picking maybe 8 or 10 individual stocks. That is going to cut in half the amount of time you spend looking for stocks to buy and following your investments. You don't even have to worry about those 3 to 5 funds you hold. They're diversified across a group of stocks, bonds, and real estate, so they're going to be getting that average return on the market. Back to our Vanguard fund list, and the biggest fee cut here in the Vanguard Total International Stock ETF, the VXUS, which saw its fee cut almost in half to just 0.05% a year. And this one might be a good substitution for that emerging market fund for its 8,500 stocks of foreign companies, including emerging and developed markets. This is the global stock market minus US stocks. This one has all the benefits we saw in that VWO. A solid 3.3% dividend yield, stocks across growth EM markets, and a low valuation of just 15.5 times on that price to earnings ratio. And you can compare this to the iShares MSCI All Country ex-US ETF, the ACWX, with its 0.32% expense fee, though with the exact same strategy of investing in companies across a range of developed and emerging international markets, with exposure to Japan, UK, Canada, and China, a global fund. And with the extra $73,000 in fees you're going to be paying the team to run the ACWX, they can afford to travel the globe on your dime. That's a difference of $1.43 million versus $1.36 million over the 30 years. And believe me, folks, I tried finding some of those more expensive funds here that outperformed, that could justify those higher fees, but it just didn't happen. When you compare two ETFs with the same investing strategy, you're going to see that they follow each other in lockstep, like here with these 13% returns over the last 5 years for both funds. The only difference is the fees. It just does not make sense to pay more for an ETF when there is a cheaper alternative. The investor loses out every time. And here I can guarantee most of you do not have enough of this next fund, the Vanguard Long-Term Bond Fund, ticker BLV, with its 4.7% dividend and new lower 0.03% fee. And I realize bonds have been craptastic over the last 5 years with those rising interest rates, but with stocks reaching some ridiculously high valuations, every investor needs some money in bonds. The BLV holds almost half of its 3,000 bonds in the safest U.S. treasuries, and then the rest in high-rated BBB and A-rated companies. Folks, having even 10 or 15% of your money in bonds is going to give you that safety and the cash you need when stocks do crash. Here, the Invesco Investment Grade Corporate Bond ETF, the PFIG, isn't a perfect match for the BLV, but it is very close with its 4.1% dividend yield. The fund invests exclusively in corporate bonds based on its fundamental ranking and holds just under 780 bonds right now. You can see in the credit quality and maturity information that these are riskier bonds, more in that BBB category and no government bonds, but it is a shorter term maturity, so average less than 5 years maturity to the bonds, which helps even out that risk. So these two bond funds may not track as closely on returns as those other funds, but again, with bonds, I'm not looking to blow the doors off return, only to protect my money, and spending an extra $52,000 to invest in that PFIG doesn't sound like protecting money to me. We've got one of my favorite ETFs next, one with a giant fee discount over its competition and in one of my favorite sectors of the economy, but cheap doesn't always make an ETF the best. In fact, I highlighted the 10 best ETFs to buy in the video here in the corner, the ETFs I'm buying this year for the best returns at any price, so make sure you check that out next. Another asset class every investor needs, and one of my favorite, the Vanguard Real Estate ETF, the VNQ, with its 3.85% dividend. The VNQ holds shares of 158 real estate investment trusts in the United States, giving you instant exposure across every property type and across the country. This is the commercial real estate market. And this 5-year return hasn't been great for real estate, posting a loss of 3.8% as those higher interest rates crushed the investment. But just as property boomed higher after the 2008 crash, these are going to do well over the next few years. Plus, going to give you that diversification in a stock portfolio like we saw with bonds. The iShares U.S. Real Estate ETF, the IYR, offers a good comparison here with its slightly lower 2.6% dividend yield and a much higher 0.39% fee. Here's where a good manager could really justify that higher fee with changes to how much the fund invests in different property types. And while we do see some percentile changes in the property exposure, the fact that both are investing across the entire U.S. publicly traded REIT market means they're still basically the same fund. While the IYR has outperformed the VNQ by about 4% total over the past 5 years, they track each other so closely that it's doubtful that outperformance is reliable, and definitely not worth the $70,000 extra you're going to be paying to hold shares of that IYR versus the Vanguard ETF. Join me on the Blossom Investing app and see the stocks in my portfolio and what over 200,000 investors are talking about with a special invite link in the description below. Or click on the video to the right to see the 10 best ETFs for 2025, the funds I'm buying. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.